Hi, so good morning, everyone. We'll start our Monday webinar now. So today we have results for UOB, OCBC, a brief on ARA US Hospitality Trust, and results for Thai Beverage. And then we have our weekly Singapore, China, and US update. So this is a disclaimer. So for UOB, the main positive for UOB's results this time around is the robust loans growth of 12.2% year-on-year, and this is mainly broad-based increase across all territories and industries. However, the main thing that is worrying about UOB's loan growth is the housing loans. It's facing increasing competition for refinancing and lesser new bookings, and this is mainly due to lesser volume of property launches. However, the first quarter is usually seasonally weaker for property launches, so we expect the contraction in loan growth to probably stabilize around the end of 2019. So we forecast a higher FY19 loan growth at 5.9%, previously was 5%, and this is mainly due to UOB's very robust first quarter loans growth. So the second positive is net trading income surged 40% year-on-year due to a rebound in financial market, and the other one is credit costs. So credit costs for UOB's impaired loans remain stable at 13 basis points. Last year, first Q1, it was 12 basis points. So that is for impaired loans, but overall credit costs rose 8 basis points year-on-year to 19 basis points. And this is mainly due to expected credit loss for non-impaired loans, which grew in tandem with your higher loan growth this quarter, as I mentioned previously, for the 12.2% loan growth this quarter. So for expected credit loss, there are mainly three drivers that drives the bank's modeling for expected credit loss. First is quality. So if there's a deterioration in asset quality, your ECL will increase as well. Second is your quantity. As you have a larger loan book or huge loan growth this quarter, your ECL will have, for non-impaired loans, will have to grow in tandem as well. And then the third one is your outlook for the sector. So based on the outlook, the banks will usually modify the ECL modeling according to interest rates, GDP growth, etc. So if your outlook is deteriorating, they will also increase their ECL provisions. So asset quality for UOB remains resilient with NPL ratio at 1.5%. A year ago, it was 1.7%. So for the negative for UOB is that the net interest margin contracted 5 basis points to 1.79%, and it is the only bank that contracted in net interest margin for this quarter. And the reason why is because of competitive loan price repricing conditions, competition with the local banks as well as foreign banks, plus they have excess deposits gathered that they did not utilize as well as the other banks. So for UOB's loan to deposit ratio, it fell to 86.6%. As compared to a year ago, it was 88%. However, we expect the interest margin to recover the next few quarters as UOB goes through loan repricing for the larger loans book, as well as reduction of the excess deposits. So UOB is going to let expiring deposits run off in the next few quarters to reduce the excess deposits that they have gathered in the first Q19 this year. So we maintain an FY19 forecast of our net interest margin 1.82% in line with guidance. So the other negative for UOB is that the fees income fell 7.4% year-on-year, and this is mainly due to decline in fund management and wealth management fees, and also due to highly buoyant market sentiments a year ago. So wealth management fees, even though it declined year-on-year, it rose quarter-on-quarter by 20% as market sentiments picked up since March this year. And as you recall, in December, for Q18, the market was extremely volatile. So we expect wealth management fees to improve if macroeconomic environment does not worsen. For the investment action for UOB, we downgrade to accumulate with a lower target price of $30.90, previously $32, and this is due to share price movement recently. And our lower target price was derived after we raised our OPEX forecast 5% higher, and this gave us a FY19 cost to income ratio of 44%. Previously was 42%. So this resulted in our lower FY19 revenue growth of 8% instead of 11% previously. As you can see from the table here, this is the UOB's guidance versus our PSR estimate. So for the cost to income ratio that we amended to 44%, which is what UOB guided. So for UOB moving forward, we expect the interest margin to pick up as they go through more aggressive loan repricing as well as prudent management of the excess deposits in the next few quarters. So the solid loans growth that we saw this quarter sets a positive tone for earnings for the rest of the year as the loan book undergoes progressive repricing. So UOB remains attractive with a healthy FY19 dividend yield of 4.4%. Moving on to OCBC. So OCBC, the main positive is net interest margin expansion. They grew the most this quarter by 9 basis points year on year, and also quarter on quarter they grew by 4 basis points for the net interest margin to 1.76%. And this is mainly due to higher interest rates in Singapore as well as Hong Kong. So for OCBC, as you recall, the whole of last year, they have been compressing their interest rates and keeping it stabilized because they want to provide the customers with more stability in their loan installments. So in this quarter, they finally caught up in their loan repricing. Secondly, they have a better utilization of their deposits. So for their loan to deposit ratio, it rose to 87%, and last year it was 84.4%. So they actually let their more costly fixed deposits lapse when they reached maturity. So we expect net interest margin of expansion of 1 to 2 basis points per quarter in the next few quarters for OCBC. And we forecast the full year net interest margin at 1.75% for OCBC, and this is a 5 basis points increase from last year's 1.7%. And the second positive thing for OCBC is the non-interest income. It rose 24.5% and more than offsets their fee income contraction. And the non-interest income, the star performer is their trading income due to higher flows in the recovering financial markets this quarter, as well as their the thing that sets OCBC apart from DBS and UOB is their insurance business. So the profit from life assurance recovered due to a more favorable financial markets as well. And for the negative for OCBC, the main thing that is contrasting this quarter is the allowance. It spiked to 249 million from an unusual low of 12 million a year ago. And this is mainly due to assumptions made by OCBC for their expected credit loss model on the oil and gas recovery. So the assumptions of a recovery did not happen. So OCBC had to reassess its OSV portfolio and take in additional provisions by substantially reducing the collateral valuations to scrap value. So the reasons why they had to do this is because the unemployed vessels require much higher activation costs in order to be utilized. And secondly, the vessels also require additional costs to upgrade its existing technology to meet regulatory requirements to be operated. So all these resulted in OCBC providing for their oil and gas sector this quarter. However, OCBC's overall portfolio quality remains stable. Their NPL ratio is at 1.5% and their new non-performing assets formation remains low. And this is because the OSV portfolio that they provided for this quarter is already inside their NPA portfolio. So we increased our credit cost forecast for FY19 to 22 basis points. Previously was 14 basis points. And the other negative is the housing loans contraction. It contracted for the first time year-on-year wise in more than a decade at 1.3%. So we believe that similar to its peers, OCBC's business is facing stiff competition for refinancing as well as lower volume of new bookings. So for investment actions for OCBC, we downgrade to accumulate at a lower target price of $12.70. Previously it was $13.70. And the lower target price is due to our increase in credit cost forecast for FY19 due to the 7 basis points increase in credit cost that we saw this quarter due to the oil and gas sector. So hopefully the provision for the oil and gas sector is the last time round, and unless the conditions worsen even further, we do not think that the oil and gas sector will undergo any more provisioning in the next few quarters. As you can see from the collateral value is already written down to scrap value. So moving forward, we expect OCBC's net interest margin to improve as they continue to reprice their loans at a sustainable pace of 1 to 2 basis points per quarter. And further upside will depend on capital markets for the investment and wealth management as well as the insurance business to turn around. And the heavier reliance on interest income should also provide stability and predictability to revenue, and this is the same for all three banks. So for this quarter, I have banking results wrap table. So over here, for the revenue growth wise, DBS did the best in net interest margin expansion to 1.88, whereas UOB had a contraction this quarter to 1.79. And this is mainly due to UOB gathering excess deposits and they didn't utilize it as well. And OCBC, they did pretty well, 9 basis points increase, even though the net interest margin is the lowest. This is mainly due to them finally repricing their loans after keeping it stable for the past year. So for net interest income, so DBS did the best because of their net interest margin. And for other non-interest income growth, OCBC did the best at 69% year-on-year growth, and this is mainly due to the insurance arm benefiting from the recovery in financial markets. So operating-wise, DBS results did the best in comparison to the other two banks. So moving on to growth, loans growth, it's stabilizing and stagnating around 5% for the sector. For the banks, UOB is the one that did the best in terms of loans growth by growing 12.2%. For all three banks wise, the housing loans growth is experiencing contractions, with OCBC contracting the most among the three banks. And for housing loan market share, DBS remains the major market shareholder at 31%. But as you can see from the figures here, UOB and OCBC remains rather competitive at 29 and 27%. So for asset quality, there's no material concern for all three banks right now. OCBC has already provided to almost the extreme levels for their OSB NPLs that have really been written down to scrap value. And for DBS, the reason why the allowance did extremely well this quarter is because of the write back of the general provisions, and as well as amendments to the ECL model due to improvement in credit condition. So for asset utilization, CASA ratio for DBS remains the highest because of their advantage in having the largest CASA deposits in Singapore. And this gives them an advantage in having the lowest cost of funds. And that is also part of the reason why the net interest margin did better than the other two banks. And as for fixed deposits, UOB fixed deposits grew the most at 18% year-on-year, which also translated as to why their net interest margin contracted this quarter because of the pricier fixed deposits that they gathered. And loan to deposit ratio, they did the worst as well, 86.6%. So for CET1 ratio, all three banks have very similar CET1 ratios right now. So their capital adequacy is very robust, and it's way above the regulatory minimum requirement. Yeah. So our overall investment action for all three banks, we have downgraded all three to accumulate, and these are the target prices. And our dividend yield for DBS is 4.2, UOB is 4.4, and OCBC is 4.3. So this is the year-to-date share price movement. So overall, in our Phillip Top 10 portfolio, we have UOB, and we like UOB because it has the least exposure to the trade war right now, which is resurging. The concerns about trade war is returning as well. So for UOB, their loans exposure to Greater China and Hong Kong is the lowest among the three banks. So moving on to Tara for ARA US Hospitality Trust.
Hi, so I'll just give a brief on the ARA US Hospitality Trust, which just closed its first day last Friday. It closed at their IPO price of US 88 cents. So this is a pure play US hospitality REIT. They have an indicative yield of 8%. They have 38 hotels, close to 5,000 rooms, a total appraised value of 700 plus US mil. Their hotels are all Hyatt branded. They are select service and as well as extended stay hotels, all in upscale region. The 38 hotels comprise of 27 Hyatt Place hotels, which are the select service hotels, as well as 11 Hyatt House hotels, which are the extended stay hotels. For the extended stay, it's something like a service residence, but unlike those in Singapore, there's no minimum 1 week leasing period, so they can actually lease for a day. But the minimum stay on average for Hyatt Place is about 2 days, and Hyatt House, because it's designed like a service residence for extended stay, it's still 13 days on average, even though you can lease for just a night there. The sponsor for this REIT is a wholly owned subsidiary of the ARA Group, which we are all familiar with. They are the sponsor for Suntec REIT, Cash Logistics Trust, Fortune REIT, and a few others. They are listed in the overseas exchanges, and it's their portfolio is managed by the US largest independent hotel management company, Aimbridge Hospitality. The lease arrangements are largely variable, so unlike the other stapled securities listed listed on the Singapore Exchange, their business trust is actually fully operating. So the PropCo, which is the wholly owned subsidiary under the Hospitality Trust, receive rental payments of both the fixed and variable components from the operating company, OpCo, which is under the business trust. So their lease arrangements are largely variable, and that's for most of the properties. Only one there's a separate lease agreement for the Hyatt Place Secaucus Meadowlands. So the growth story for them would be that the select service is poised to outperform the full service segment in the US because of the compressing corporate budgets as well as the dynamics of the both corporate and leisure demand. The previous 5-year RevPAR CAGR was about 4.6% for the select service hotels, and this is higher than the full service hotels. And even going forward, the expected RevPAR CAGR, this is based on their independent market study that it did, would still be higher, about 2% for the select service hotels compared to 1.3% for the full service hotels going forward. So they are in a good place to ride on this growth, given that their most of their hotels are in the select service region. And their gearing currently is at 33.4%, price to NAV of 1.02%, and NPI margin of 30%. Moving on to Paul.
Okay, thanks, Tara. Move on to Thai beverage results. Okay, the title is basically because the beer segment did very well this quarter. Okay, move on to the details. In terms of the if you look at the sales, I think the weakness came from spirits. Just to recap, in Thailand they sell the brown and white spirits, and 80% of the net profits for the group actually come from spirits. What did well this quarter was the beer sales, especially from Sabeco, where volume grew into the mid-teens, and they mentioned that the market's actually only growing about 4%. So they're actually grabbing quite a large chunk of market share. The other positive was, you can't see in the numbers here, but there are non-alcoholic beverages, which is like carbonated drinks, ready to drink tea. The losses there actually halved. But in terms of the negative, again, what happened is that the spirit sales were actually down 5.8%. This is due to, if you recall, last year, there was an increase in duties. So last year, there was a big spike in sales in March last year, because due to the duties, there was going to be price hikes in April last year. So that's why you were comparing being somewhat lumpier March of last year. So that's why part of the decline was due to this. They still say that the market is growing probably about 3 to 4% per year. 2 to 3% per year. In terms of the outlook, I think Sabeco will still do well. So you will still see this beer sales portion still perform well, because there's actually going to be a price hike in March. And according to management, again, they mentioned that the volumes don't really get affected even when there's a price hike, and the market seems to absorb the price hike pretty well. Other parts of Sabeco will also perform well as they are doing some major cost restructuring and branding efforts. I think the details are in the report. Basically, they have like 25 breweries. Not all are owned by them, so they're just sourcing more of the breweries from their own. So this will help perk up a bit of the margins. But the issue we have is that even though Sabeco is doing well, beer is only 7% of net profits. And also, even though there was huge growth in Sabeco, as you can see from this part here, Sabeco earnings are suppressed by the surge in interest expense, because they had to borrow quite heavily to purchase Sabeco. So Sabeco won't filter through into the group earnings until, I don't know, the next couple of years at least, because they need to at least par down some of the debt. But in the near term also, the spirits could get some boost because, as you know, there's some king coronation. So that should have some celebrations around various provinces, and that should actually still give some momentum to sales for the key spirit business. In terms of recommendation, we still maintain and accumulate. We just moved up our price a little bit because of we upgraded the net earnings about 5%. But for us, our view is just that the spirit business is very mature, and only beer can drive any growth back for this company, and it will take some time. So that's why we still have maintain. Okay, I'll move on to the Singapore Weekly. In terms of the key updates, what we have is for Singapore macro, we have the key number was actually retail sales was down 1.5%. Sales was actually very weak. Retail sales in Singapore is very weak. Actually, it was down 2.2%. Actually, it's worse than the 0.6% drop in the fourth quarter. So retail sales is pretty poor out of Singapore. I think we focus more on, obviously the main topic is on the trade talks. Just a couple of points that we are just going to highlight. Again, whether there's the first point is that so long as there's Lighthouser doing the negotiations and there's even some bipartisan support by the Democrats, I think this trade is going to be hard to resolve. I think we can only see any resolution if the two key pain points for Trump happens. Obviously, the first pain point is that there's a huge market correction out of the US, and the other thing to note is that the next set of tariffs on that so-called 320 plus billion, actually most of it is on consumer goods. So actually this will actually hurt his so-called voting base. So that is harder to push through in terms of tariffs. In terms of the China stimulus, I think there will obviously be a Chinese stimulus in view of the breakdown of the talks, but I think the stimulus will only just protect any further downside. I don't think with their worries over the leverage in the country, any stimulus will be just more like a L-shaped kind of support rather than build any momentum. And the fourth point is that the global economy is not strong, and with the current trade talk situation, is going to cause further paralysis to the supply chain, especially for electronics. In terms of the direct impact from this 200 billion, it's actually pretty small. I think we got a chart that you can refer to later. The impact probably on paper, at least, the direct impact is probably about 0.1 percentage point on the US economy. But of course, more worrying is the indirect impact through loss in confidence and sentiment. So tactically, we're bearish in the very near term, and also we think that we should seek shelter in some of the yield stocks. In terms of the weeks ahead, I guess the only hope we probably have is there's a 28-29 June G20 summit where both Trump and Xi might actually meet again. I mean, these are just some details. These are just some of the type of goods that have been impacted by the tariffs. As you can see, the one that's going to be hit now, about 50 billion is consumer goods, but the big one, he claims is 300 plus, but actually it's more like 200 plus billion. Basically, all imports from China hit tariffs. The large part of it is consumer. So this will be more not so easy, politically not so palatable as this will actually hurt his voting base. In terms of the GDP impact, again, all kinds of forecasts here in terms of how you want to kind of model in the impact of the tariffs. But if you use this kind of average between all these various kind of studies, even if you assume a 200 billion two-way trade impact, the impact to the US GDP is probably about 0.1 percentage points. But again, these are all direct impacts. The indirect impact on sentiment and confidence is probably more severe. This is just some details if you want. But anyway, if the next batch of imports, the 300 plus billion, the products that we hit will be all this, like 100% will be on toys, equipment, footwear, textile clothing, electronics. So this will be the next batch of tariffs if he actually imposes. And this will obviously hurt the consumer, US consumer. These are the ones that's being imposed. Okay, I'll move on to China.
Thanks, Paul. For China last week, the trade talks between US and China's main headlines for China last week. I will summarize the China's reactions against the 11th rounds of the trade talks later. For the monetary policies, on last Monday, PBOC announced that they will cut down the RRR rate to 8% for the banks which operated assets less than 10 billion RMB, effective from the May 15th. These policies will affect about 1,000 small-sized banks and will release about 218 billion RMB. Because the cut down the RRR rate on May is unusual, the PBOC didn't cut down the RRR rate on May since 2012. While thinking this the reactions is mostly to offset the negative impact of the trade war. For stock market last week, we are seeing the crossing list over sectors are falling, basically because of the negative news of the trade wars. For China side make the first official reactions against Donald Trump's on Thursday, since the China side are still committed and keep its promise. On Saturday, the the vice primes, the Liu He's, are saying China and the U.S. negotiation are still going on, which are not being broken, and the next round of the talk will be happened in Beijing. For the first quarters of the stock market rallies, we are thinking not because of the good news between the China and US side. We are thinking the main reasons the stock market rally in the first quarter is because of the enough liquidity, which show as the total outstanding balance of the margin transactions. We are seeing there is the same amount of the liquidity increasing as well as the stock market increasing. For the stock recommendations, our Hong Kong research teams recommend NetDragons. Basically, because of the 2019, the revenues are beat expectations. The revenues increased nearly 30%, and the net profit are turned into the profit rules to the profit gaining. Also, with the new games launched in the 2019, the NetDragons valuations have hoped going up. Our Hong Kong research teams to give NetDragons the target price of the 13.22 Hong Kong dollars. On this week, we are waiting for the MSCI to announce the list of the 12 chain next stock that will be included in MSCI Emerging Market Index, effective from the May 18th. This is a list of our Hong Kong research team stock recommendations. We added the NetDragons. I will move to the Edmund for US Weekly.
All right, thank you, Jian. So right now I'll move on to the US Weekly. So just a bit more about the trade war. So if the dispute is not resolved, we could see a repeat of what we saw last summer after the US imposed tariffs of 50 billion of imports from China. So back then, we can see that the equities around the world generally performed poorly. And this was particularly the case for economies that are most vulnerable to the rising protectionism. By contrast, if you look at the graph, the US equities itself actually performed quite well. While their outperformance may have been partly due to the superior economic performance in the US, it probably reflected that protectionism will be less damaging to companies in the US than to those abroad. But of course, in the short term, it is likely that we will see a sharper correction ahead. So as for the trade deficit, it widened to 50 billion in March, and close to 1/4 of the 2.2 billion increase in exports was due to a 0.5 billion increase in the soybean exports. And this is likely to reverse because China is likely to retaliate and impose tariffs on US exports as well. As for the mortgage applications, it increased 2.7% for last week. The average interest rate on the 30-year conforming mortgages remains relatively unchanged, while jumbo loans average down to 4.27%. So because a lot of the large banks has a higher proportion of jumbo loans, so with the interest rate being lower, it is a positive sign for the large banks, as it is more likely for the people to go for jumbo loans. So for the week ahead, some of our key indicators to be released will be the existing home sales, mortgage applications, and the durable goods orders. So this is the list of the upcoming earnings results release. All right, thank you. We have come to the end of our webinar. We'll take any questions.
Yeah, I think we got a question why Thai beverage dropped by almost 10% today. Actually, based on the results, it wasn't as bad as the headline was. There was some quite aggressive calls before that. I think because Sabeco had some very strong numbers. I think there were a few brokers promoting it prior to that, but I don't really see the sell down as so warranted because part of the weakness, again, there was some one-off factors for the weak numbers out there. So sorry, the slides is actually accumulated. Actually, our recommendation is neutral. It's a typo there. But I don't see it being warranted actually. This kind of, but there's no news that we heard of. Of course, you can also speculate that there's still this tax dispute that they have with the authorities, but yeah, that could be one factor. But I doubt that was the reason for the weakness.
There's a question on how will the tariffs imposed last Friday affect SG REITs, if any. So this is quite a broad-based question, but if anything, will be more of the interest rates. The flow-through will be in the interest rate, so it's a positive effect for the REITs. Then again, you have to take into account the different all things unchanged, the interest rates would be affected in a positive way, but That's notwithstanding the other demand supply dynamics that's happening on the ground. But yeah, the interest rates will be the flow through impact from the tariffs.
Hi, there was another question. Fitch lowers outlook for Thai Bev to negative on slower than expected leveraging on 11. Okay, yeah, I thought it was in April actually, but anyway, I think if you look at the most recent results, the cash flow that's coming out, operating cash flow, I think regardless of what has been said, they're still generating almost 2 trillion of 20 trillion, sorry, of operating cash flow. If you look at the first 6 months of if you look at the first 6 months of their operating cash flows, they're still generating very strong cash flows for Thai Bev. And also in the call, they are quite still very far from any of their debt covenants that's been imposed on them. So I'm not too worried about this so-called negative rating by them. And more importantly, I think Sabeco, as you mentioned earlier, they're making a lot of progress in growing this acquisition. So I'm not so worried about their leverage on their so-called credit rating. I'm more worried about it's more on the operating earnings that you won't get the kind of growth that you can get from Sabeco.